Hello, I'm Denise Schwieger, a banking and capital markets tax partner at PwC. This is PwC Tax Insights in Brief.
And I'm Abe Sedgh, also a banking and capital markets tax partner at PwC.
On July 4th, the One Big Beautiful Bill Act was signed into law. Now finalized, this legislation includes a mix of extensions, enhancements, and repeals that will have a direct impact on the banking and capital market sector. Today, we'll walk through some of those relevant provisions.
That's right. And importantly, some expected proposals didn't make it into the final legislation, such as the Section 899 retaliatory tax on discriminatory foreign jurisdictions. That provision was dropped following the U.S. reaching an agreement with other G7 countries regarding the application of the OECD's Pillar 2 global minimum tax rules, specifically concerning U.S. multinational enterprises. The G7 agreement calls for a side-by-side system where U.S. multinationals will be largely excluded from the income inclusion rule and the undertaxed profits rule under Pillar 2. In response, congressional leaders ultimately agreed to remove the proposed Section 899 retaliatory tax provision from legislation before it left Capitol Hill. There's also no corporate rate hike, no new limits on SALT deductions at the corporate level, and no changes to the tax exemption for credit unions.
That's right, Abe. And there's some additional good news for banks. 100% bonus depreciation is back and made permanent for property placed in service after January 19th, 2025. Section 174 domestic R&E expensing is also restored on a permanent basis. This is welcome relief, especially given the cost pressure from rising compliance and technology investments.
That's right. And on the international side, the bill renames and reshapes both the GILTI and FDII regimes. The GILTI deduction is set at 40% and FDII at 33.34%, both resulting in an effective tax rate of around 14%. Notably, the QBI component is eliminated, which will increase tested income for many banks but also broaden FDII eligibility. The beat rate is increased to 10.5% and 11.5% for banks and securities dealers. But critically, the House's earlier proposal to limit general business credits was ultimately not adopted.
There are also changes to the expense allocation rules that clients will need to consider. In addition, Section 162M is now slightly more restrictive, requiring aggregation of compensation across control group members for purposes of applying the $1 million deduction cap. That could create significant financial reporting implications, especially for executives compensated across multiple entities. However, this change is more limited than some options Congress was reported to be considering.
Let's talk clean energy. Many financial institutions have bought or traded IRA credits, but this legislation either repeals or restricts a broad set of these credits. Plus, there are strict limitations on projects involving prohibited foreign entities or receiving material assistance from them.
That's right. So banks are going to need to analyze the deals that they've either been looking at or entered into. There's also the new remittance transfer excise tax. This survived the final version of the bill and is effective after 2025. So this provision states that a 1% tax will apply to certain foreign cash remittances, although debit and credit card funded transfers are excluded.
That's right. And don't forget the 1% floor and 10% cap on corporate charitable contributions, which will require some banks to reassess their giving strategies.
In summary, the final legislation is broad and complex. But for BCM clients, the takeaway is clear. Changes to R&D expensing, bonus depreciation, international provisions, and clean energy credits are likely to impact both the effective tax rate and cash tax positions, as well as operational decisions.
PwC is closely tracking all the guidance and implementation issues. Remember that the bill was enacted in Q3, but companies should consider whether any Type 2 financial statement disclosures should be made with the Q2 Form 10Q. And also, we'll continue publishing updates and audio casts for our banking and capital markets audience.
For a deeper dive, read the PwC FS Tax Insight and register for our Tax Readiness webcast on July 15th. Thanks for watching PwC's Tax Insights in Brief. We'll see you next time.